Hey everybody, this is Paul doing a video. Market is closed. It's 5:39 Central Time. And I think now's a good time to do a video, kind of a year-end summary type thing. Winners, losers, 2023, I guess, predictions. And then, yeah, we'll kind of see where we go. So as you can see, portfolio has kind of changed since the last time I did a video. I do post on Twitter whenever I do decide to change my mind on something. So if like certain things hit price targets earlier than I thought they would, like so say if I thought something was going to hit something in February, for example, I'll typically pick it up. Or if I think it's kind of put in a low, for example, um, I'll pick up different stocks, that type of thing. So I'll add to different positions. I'll sell to different positions. I'll try to update that on Twitter if possible, just giving a heads up on like what I've been up to. So I definitely reduced some of my positions that were going up. I have a feeling sometime in January it's either going to be the end of this month, maybe the last trading day kind of thing, or maybe in January, February kind of thing. We're going to see some big time selling. There seems to be some people very determined to retest those lows. But then you also have the U.S. consumer posting, just still doing their thing. Um, So you still have maybe there's a lot of people that think maybe inflation will kind of get down maybe to this four area, then kind of get stuck there. So this chart kind of implies how quick we can get there. I went over this chart multiple times from Bespoke, but this is kind of where we were. Or it just very much there's some people that think inflation is going to be sticky. There's some people that think inflation is going to roll over very quickly, but you have to there's just so many recessionary signals setting up. It's kind of hard to keep track of them all. But these are just different things where, if we go into a real like hardcore bear market, you could see 2800 average bear market. So I can show this chart a little bigger. So average bear market, no recession. So you see 3400. That might be where we go back down to if we don't get a recession. But if we get a recession, that involves earnings, that involves job layoffs, that involves 6-7% unemployment. That's where you get down to 2,800. And these are the different support levels and whatnot. But so if you want to pause the video to kind of look at this chart, but it's just a very good chart that I picked up there. So how am I positioned going into the end of the year? It's kind of how you see right here. I've definitely added more into SPHD. Um, It's a monthly payer. That's pretty much one of the bigger differences between that and SP or SCHT. Um, so it's run by a different firm too. The other one runs it's through Schwab. This one's through Invesco, but similar names in both of them. In fact, in SPHD, there's actually some overlap. They include AT&T, for example. They have Walgreens in there, which could give me justification to sell AT&T and could give me justification to sell Walgreens and enroll that into SPHD. But anything that I sold today, just so you know, was at a profit. So Home Depot, CHD that I had, Caterpillar for some reason was hitting record highs or something, just some insane amount. So I only had like I think 4 shares of that, 1 share of Home Depot, 1 share of Walmart, but all of these were up like 14%. And I don't like to add to them when they're that high if I'm expecting a recession. It doesn't make any sense. So it's just positions that were just kind of sitting there gathering dust. Another one, for example, to say Travelers right here. Um, I think when this pays the dividend, this might end up being another one. So you see it's only got like 380 bucks. I might end up rolling that into SPHD also. It's like a 1.95 yield on it. It's a very reliable company. And it'll probably be around for another 100 years, but I prefer to roll something like that into a. This really relies on heavy travel, that type of thing. So you're starting to see travel bans, that kind of thing. Not travel bans, but like the thing with China today and the COVID testing and that type of stuff. So could affect it. Not sure, but it's just a stock I don't understand too much of, and I've never really had a huge position in it. So this is probably going to be the next one that gets rolled in SPHD by the time I do another video. PG, I actually am going to add positions to it once it comes down. I'm not buying it at these levels. Like I said, if I expect a recession of some type, minor, big time recession, it doesn't make sense. And last time I got it, it was at 145. So why SPHD? Very simple. It's been very reliable. Um, the dividend goes all the way back, very reliable to the start of the fund, which if I can pull up each right here. So if I go out to max, so fund goes all the way back to 2012. It's had drops. Biggest drop was during COVID, obviously, but as you can see, the dividend's been extremely consistent. Even during COVID, it was still paying the dividend. That's very different than QYLD. QYLD definitely shifts all over the place depending on the time of the day, and they shift their dividend date constantly. So that's why I could drop that. So that's why I'm building up a position in that. If you like SCHD, you like SHD. I just like SPHD. They're both high yield dividend trackers. So that's kind of what we have there. So what's going on in the market? Like, what in the world's going on? It's very hard to tell you. The market is kind of priced all over the place. So oil's priced like we're not going into a recession. Gold is not priced like we're going into a recession. Um, the bond market is pulling back like we're not going into a recession. So yields are coming down like the Fed's going to ease, which the Fed said they're not going to do. In fact, they said they're going to raise more. The dollar's coming down like we're going into a new bull market. The VIX, which is right here, which tracks volatility, is down like we're not in a recession. So you have a very large amount of conflicting indicators. So trying to tell you what's going to happen in this market is literally impossible. So what I decided to do in this video was go over like just different plays that I made throughout the year, things that just utterly backfired. Um, reasons why I made different plays. So at the beginning of the year, I was working regular old job, corporate job. I think I had close to 70,000. No, maybe 50. I think it was 56,000 invested, or 50. Yeah, 56 or so. So I left my corporate job, and at that point, I decided to sell all my stocks, or sell a very large amount to pay off debt. So you can see the debt difference right there. I decided to sell a very large amount of stocks that were winning. Little did I know that was effectively the top of the market for the year. Didn't know. Had no clue. I just did this out of convenience. So it looks like a genius move on my part to actually pretty much sell almost a few days before the whole market just decided to go, belly up for the rest of the year. So there was no genius technical analysis I did there. I was just very value focused. I had a lot of stocks that were very, very high after December, and I left my old job. And then I decided to maybe try like a semi-fire type thing, So I came up with this great idea, which was the different call ETFs, because the Fed was saying they were going to raise and inflation was up. And I was listening to some videos of mine where I said they couldn't control inflation, but little did I understand that this same Federal Reserve would have no problem tanking the market or running up rates the way that they did. Never seen it in my life, just haven't. I have not been investing. Like the last time people saw that was Alan Greenspan. But the problem was the reason why I didn't believe them is because they said they were going to do that. They were going to raise rates in 2018, and by December 2018, they completely reversed course, dropped rates down to zero, and then by September they were doing QE again. And this was before COVID, so I didn't believe them. Just didn't believe them. So that's why I took up those positions, and specifically the ones that I took up positions in was very large positions in BST, BSTZ, QILD, I believe at the time. At the time, I had no reason not to think everything was going to be fine. I watched a whole bunch of videos on which ones to buy. Just looked around, so I decided I could have thrown at every dime I had into QILD, and thank God I didn't. But I decided to diversify a little, do something like that, and then, I bought like this municipal fund. So and then I had SPHD only sitting in my IRA. So I said I needed something high yield that pays monthly. And, I'm gonna try and pay my bills off of that kind of thing, and it kind of worked for say 2 or 3 months. Um, but then I started to notice that they kept raising rates, and then they kept raising rates, and they kept raising rates, and then they kept raising rates. So that's it's kind of a hard lesson learned. Is that it's the one thing the Federal Reserve does seem to kind of take seriously. So, in the period of time that we've had zero rates, this country has added 20 trillion in debt, and the Federal Reserve really hasn't cared. Because if you look at when they started, when they lowered rates down to zero originally, it was after 2009. We had maybe 9 trillion, 10 trillion in debt, and we're at 30 trillion now. Nobody said anything. They said it was a big concern. They never raised rates to do anything, because inflation was always under 2%. It was actually staying below 2%. They couldn't even hit 2%. So that's definitely a lesson learned. Good news is I was able to easily make up any losses. For example, when I started doing like DoorDash, just the different gig economy stuff, that was very easy to make up that money. Um, you know, Threw a lot of that money in here. And then I became very bearish over throughout the year, as it became very obvious that not only were they hiking rates, but they were hiking rates way, way too much. They were basically hiking us into a recession. So you can kind of see the different bear legs. So there's pretty much when I sold. So you can see the 20-second. So you can see right here. Here's the top, and then I sold, and this is when I got the tech ETFs. And then I didn't think it was that bad of an idea until April, May, June, and then you started to see this insanity from 4,600 down to 3,600, and then it went back up, and then it went back down. So you can see and then it becomes very clear that you're in a bear market headed towards a recession as every single key indicator flips over. So just different charts. For example, even the New York Federal Reserve probability of a recession literally says that there's a high chance we're going to have a recession. But the Federal Reserve refuses to say that word out loud. So that was my biggest mistake of the year, is just effectively not believing the Fed. Um, like they said, you don't fight the Fed when they were lowering rates and doing QE. Well, it applies in the other direction when it comes to inflation, apparently. But hard lesson learned there. And there's a lot of people that made that mistake around that time because nobody believed the Fed was serious. Nobody thinks the Fed is serious right now. When they say that they're going to do another 75, when they say that they're going to take this number right here up to 5.1 by the end of next year and hold it there. Nobody actually believes the Fed. If anything, they're pricing in cuts. So that should give you a general idea of just how trained this market is after 10 years to just, we don't believe the Fed. We think if you actually get a real recession with a market crash, you're going to just completely back off again. And to be fair, I kind of believe them. That's why I haven't pulled, that's why I'm still in the market. But so that's where we're kind of at right now. So I would say easily, by far my biggest mistake of the year was those tech call ETFs in, I believe, March. You can kind of see I was doing fine, but as soon as I got into those, it's when I started basically riding not the Dow, is when I started, my market performance started performing similar to what you see in the NASDAQ. Now, when I backed off things like QYLD and I backed off very large positions in BST and BSTZ, the NDX or the NASDAQ strikers, that's when it became a much better. But as you can see, I'd already taken 26% losses, 33% losses in those. And these have been paying dividends, as you can see. Every month they pay dividends, so you can kind of see. So they've been paying dividends this whole time. It's just, it's not pretty at all. I even added some positions here recently on, when it's, because I expect like maybe like a China reopening, that type of thing, to make it, help this fund out a little bit. So you can kind of see I've had dividends turned on the whole time, dividend reinvesting this whole time on those. But yeah, it's definitely not pretty. I'll tell you that. So those are going to be the ugly parts of my portfolio. Um, Intel, for example, is going to be another one that's going to be there probably for another 10 years. That's going to be kind of it's going to be kind of nasty to look at. This was another one. This is a utility tracking ETF or a mutual fund. Got a hit too when they raised rates. So that's kind of what we're looking at right there. So there's just definitely some parts of the portfolio that have just been hammered. So that's kind of where we're at now going into 2023. I think this is where I'm going to keep it outside of maybe dropping travelers once the dividend pays out. But I think that's kind of where we're at. And then I'm going to bolster this position in SPHD to be my biggest one. And then just kind of go from there. Just kind of build up from there. Um, and hopefully there's not some huge crash, but I mean, the chances are it does look kind of likely. Another reason I went with SPHD, for example, this is my IRA. I really never show this account ever because there's really nothing that happens in here because it's all passive ETFs kind of thing going on. So you can kind of see when I originally got into SPHD was March 2001. So you can see I'm still, and this has had dividend reinvestment turn on the whole time, but you can kind of see it's still up 6.71% even with everything we've gone through. So that's definitely a check mark for long-term investors that probably should have done something maybe like threw it all in SPHD, but I didn't want to be all concentrated in one fund, even though it is kind of like a passive tracking ETF. So, but there are some people that just do that. Like you open their portfolios, there's literally like two funds. So, might be where I'm heading to once I get tired of like tracking individual stocks because most of my videos I don't even talk about my stocks. I talk about like just different trends I see in the market. So, but as it stands right now, I would say that was my biggest mistake this year was easily anything related to tech call ETFs. It was definitely a big mistake to go that far. I think 50% of my portfolio was concentrated in them. That's because I was trying some kind of weird thing like, like to pay everything off on dividends on funds that were very volatile to very, very volatile to any kind of rising rates. At the beginning of the year, I think rates were like, the 2 year was like 0.4. And look at where it's at now. Like that's a lot of raises right there. I didn't do stuff that other people did. Like there's some people that went all in Tesla at the beginning of the year. There's some people that went all in just these insane names. Um, all the Cathie Wood names, like these Chinese stocks, for example. I know people that got hammered, just destroyed with those. Um, the different COVID names, just to like Zoom and stuff like that. There's people that are down like 90%. So being down 13% isn't too bad. There's other people that know how to play bear markets very, very, very well because they do seem kind of predictable, especially when you have the Federal Reserve saying they're going to raise and then they actually do what they say they're going to do, which is something we've never really experienced in my whole life. Like they said, between 2016 and 2018, they only raised the rates like 2%. Now, in less than 9 months, they've raised it 400 points. So I've never had the Fed really do that and actually go through with it. But when they actually do what they say they're going to do, I think some people are just like experienced enough to know, like, you know, they can predict it and know when it's going to hit a low, when it's going to hit a high, kind of thing. So that's why the technical guys have been so right this year. That's why they can draw lines on a chart all of a sudden and the lines do what they're supposed to do. Previously, when it was at zero rates and QE, the lines didn't do what like everything was above where it was supposed to be. It's just straight lines up kind of thing. So if we got to the 1 year, by the way, or where are we at on a 2 year? As you can see, if you were in the NASDAQ and you didn't sell at the highs, you lost everything. And you're also negative 20% down. Actually, take it out 3 years, you're still up. But if you got in right around when they started sending out stimulus checks and that kind of thing, or when Biden took over, you can kind of see. But if we go out 3 years, I outperform everything. That's because for this part of my portfolio, I didn't touch tech whatsoever. From there to there, didn't touch tech one time at all. I think maybe Apple or Microsoft in there, maybe like a few shares, but I got rid of them when they made a profit because the dividends are garbage. But So, you can see I was up 56% by this point. And then the NASDAQ at that point was up 58%. And now, over 3 years, it's up 14. So I can give you a general idea of just how bad it's been. So over 3 years, doing great. It's just this year I went away from my original philosophy, which was this was supposed to be a dividend tracking portfolio, and I got caught up in the call ETF thing. So you live and you learn. So that's where we're at. Like I said, for 2023, can't even hope to tell you what's going to happen. Can't. Don't know. Market wants to crash. Consumer is still spending money. You can't have. Consumer needs to stop spending money if you want the market to crash. They could try and crash it on technicals, but that somebody's earnings will come along, like Tesla's earnings will come along and say, hey, look, everything's fine, or Apple's earnings will come along and say, hey, everything's fine, or the bank earnings will come along. You know, you just don't have enough bad news in the earnings yet to say this market will crash when the earnings go. That's what everybody's waiting for, and the earnings just haven't gone yet. So that's what we're waiting for in 2023. Nothing really too amazing there. I think it's just that continued slowdown is what you're going to see. So that's where we're at right now. So let me know what you think in the comments. If you have any questions or kind of thing, if you want to make fun of me for buying those call ETFs or say told you so or something like that, go for it. Because there were people that predicted that that's exactly what was going to happen. I said, nah, man, the Fed's going to turn the minute that the market turns, and the Fed did not turn when the market turned. So hopefully, you know, hopefully this helps, and I can remember this a few years from now. Maybe we'll go through all this again. So thank you. Y'all have a nice day.